nice to meet you. My name is Scott. Recently just joined the Free Network, so I hope to keep you informed with the latest, and I look forward to the journey. So on to today's topic, and that is the new Fed bond buying initiative. So as you may or may not know, the Fed have allocated around $750 billion into buying individual corporate bonds. And this is huge because it's completely unprecedented. We've not done anything like this before in terms of the Fed's historical policy packages. So this is a major physical stimulus, and which is why we've seen the dollar sell quite heavily on last Friday's session. But, for those of you that don't know kind of what a corporate bond is, well, essentially it can be summarized in one term, and that is IOUs. So when a company wants to raise finance, when it wants to raise money either to expand or because they need funding to stay alive, they can do using a corporate bond. So they can issue a corporate bond. So secondary market participants like me and you, we can then lend money directly to a corporate company through this bond. Now these corporate bonds will usually have two things, and that is a maturity. So that's a lifespan, sort of lifetime of that bond. And that's normally fixed. So you can have 5-year bonds, you can have 10-year bonds, and at the end of that period, that bond will no longer cease to exist. And then you also have an annual sort of cash flow being paid out, and that's normally in the form of a fixed percentage. So let's say I'm Tesco. Tesco is obviously a massive supermarket chain, and I've decided that I want to issue a 10-year corporate bond paying a 3% annual interest. So if I invest £1,000 into this bond, every year I'm going to receive 3% of 1,000 for that 10-year period, and at the end of that 10-year period, I'll get my original £1,000 investment back. And that's how these corporate bonds work. However, what's really interesting about this Fed buying program is that the Fed are buying both secured corporate bonds and also buying junk bonds. Now, junk bonds are unsecured. What that means is that the companies that are issuing those bonds, number one, they don't have good credit ratings. So there's a very low possibility that they will actually pay back the money on those bonds, that you will actually receive your original investment back at the end of that sort of maturity date, or that you'll even get the annual interest. And those are considered to be not investment grade. So it's very interesting that the Fed have decided to also buy junk bonds as well. And because they're unsecured, it means that if for whatever reason the company issuing those junk bonds goes under administration, so they go bankrupt for whatever reason, then you don't get your investment back. But with a secured bond, if a company goes into administration, then that company's assets are liquidated, and that's used to basically refund, I'd say, people that bought into bonds. So they will get their money back. So it's very interesting that the Fed have bought into these junk bonds because they're not investment grade and they're not investment worthy as well. But in terms of this corporate initiative then, it's good because it gives companies, corporate entities, two main benefits. Number one is that it's much more cheaper to lend directly from the government. And then number two, companies that don't have great creditworthiness or great credit ratings, i.e., the companies are issuing these junk bonds, they actually get a chance to be funded directly through the government, so they have that additional source of funding. So that's a benefit for them as well. So later today we've got Powell speaking, and hopefully he will address concerns as to, for example, why he's buying junk bonds as well and not just outright secured bonds.